Something changed on January 1st. Not announced in headlines, not debated in Congress, not explained on financial networks, but something fundamental shifted in the global monetary system. And if you understand what happened, you'll see why silver just became the most important asset of 2026. While everyone was watching cryptocurrency prices and stock market rallies, the real digital revolution was happening in physical metal. Silver closed 2025 with a 147% gain, the best performance since 1979. But this isn't about past returns. This is about recognizing a pattern that's played out 3 times in the last century. Always the same sequence, always the same outcome. When monetary systems break down, when currencies lose credibility, when governments choose inflation over honesty, precious metals don't just perform well. They become the foundation of survival. And right now, all the indicators are screaming that we're entering that phase. The pattern is mathematical. It's predictable. It's already begun. Let me show you what's really happening. Because once you see it, everything else makes sense. On New Year's Day, China implemented new export controls on silver. Not a ban, something more sophisticated, something more dangerous. They restricted silver exports to just 44 government-approved companies, firms that must produce at least 80 tons annually and maintain $30 million credit lines. This isn't about environmental protection. This isn't about resource conservation. This is about weaponizing supply chains. China controls 60 to 70% of the world's refined silver production. They just put a bureaucratic chokehold on global supply. And they did it quietly, systematically, without fanfare. Within days, silver prices exploded past $90 per ounce, record highs. But the price isn't the story. The story is why this happened now, why China made this move at this precise moment in history, because they see what's coming. They understand the pattern. They're positioning for a monetary reset that most people won't recognize until it's already over. Look at the numbers. Really look at them. Silver has been in supply deficit for 5 consecutive years. Physical shortfall approaching 250 million ounces annually. Industrial demand growing exponentially. Solar panels, electric vehicles, electronics, defense applications, all requiring silver, all competing for shrinking supply. But industrial demand isn't driving this rally. Industrial demand is predictable, steady. This is something else. This is monetary demand, safe haven demand, crisis demand, the kind of demand that emerges when people start losing faith in paper currencies. And that loss of faith is accelerating. The Federal Reserve just cut interest rates again, 3rd cut in 4 months. They're choosing inflation over economic honesty. Again, they're debasing the currency to keep the system functioning, and everyone knows it, including China. Real interest rates are negative. Treasury bonds pay less than actual inflation. Cash loses purchasing power daily. Where does capital go when all traditional safe havens are compromised? Into hard assets, into things that can't be printed, into silver. But here's what makes this different from previous precious metals rallies. This isn't just about American monetary policy. This isn't just about dollar debasement. This is global, coordinated, systemic. Look at what's happening simultaneously. China restricting silver exports. The United States adding silver to its critical minerals list. Geopolitical tensions spiking from Venezuela to Greenland. Central banks buying gold at record levels. ETF inflows returning to precious metals after 2 years of outflows. These aren't coincidences. These are symptoms of a system under stress. A system preparing for change. A system that recognizes precious metals aren't just commodities anymore. They're monetary assets, strategic assets, survival assets. The comparison to 1979 is deliberate, intentional. Because 1979 was the last time silver performed this way, and 1979 was the last time the monetary system was this unstable. Inflation was raging, interest rates were rising, the dollar was losing credibility internationally, political instability was spreading, Iran, Afghanistan, energy crises, economic stagflation. Sound familiar? But there's a critical difference between then and now. In 1979, Paul Volcker could raise interest rates to 20% and crush inflation. The federal debt was manageable. The government could afford to pay higher rates on its borrowing. Today, federal debt exceeds $38 trillion. Interest payments alone consume over $1 trillion annually. The Fed cannot raise rates high enough to control inflation without bankrupting the government. They're trapped, cornered, forced to choose between economic collapse and currency destruction. They're choosing currency destruction, obviously, predictably. And precious metals are pricing in that choice. Silver's industrial demand creates a floor. Its monetary demand creates a ceiling. And that ceiling keeps rising as confidence in fiat currencies keeps falling. The clean energy transition requires massive silver consumption. Solar panels need silver paste for conductivity. Electric vehicles need silver for batteries and electronics. 5G networks need silver for components. Artificial intelligence data centers need silver for cooling systems. Conservative estimates suggest industrial silver demand will increase 30% by 2030. But supply isn't keeping pace. Mine production has been flat for years. Recycling can't fill the gap. Above-ground stocks are depleting. Now, add monetary demand on top of structural supply deficits. Add safe haven buying. Add crisis hedging. Add institutional allocation shifts. The mathematics become impossible. China understands this, and that's why they're hoarding silver domestically while restricting exports. They're not just controlling supply, they're accumulating strategic reserves, preparing for a world where silver becomes monetary infrastructure again. The United States is finally awakening to this reality. Adding silver to the critical minerals list signals recognition that this isn't just an industrial commodity. It's a strategic resource, a national security asset. But recognition isn't accumulation. Awareness isn't preparation. America is still dependent on imports for most of its silver supply. And those imports are now controlled by countries that may not be reliable partners. Venezuela represents more than oil reserves. The Orinoco mining arc contains significant silver deposits, along with gold, coltan, and rare earth elements. The U.S. intervention isn't just about energy independence, it's about critical mineral security, resource diversification, reducing dependence on adversarial suppliers. But even if Venezuelan silver production is restored, which would take years of investment and infrastructure rebuilding, it wouldn't fundamentally change the supply equation. The deficits are too large, the demand growth too steep, the existing reserves too concentrated in geopolitically unstable regions. That's why silver is behaving like digital currency, like cryptocurrency without the volatility, like Bitcoin with industrial utility. It's portable, divisible, recognizable, and scarce. It can't be printed, hacked, or confiscated remotely. It functions in any economic system, under any government, in any currency regime. Unlike gold, which is primarily monetary, silver bridges the physical and digital economies. It's required for the technology that powers modern life while retaining its historical role as money. This dual utility creates unprecedented demand dynamics. Central banks are finally recognizing this. Russia has been accumulating silver reserves since 2022, the first major central bank to add silver to official reserves in decades. Other countries are quietly following, not announcing programs, just accumulating, diversifying, preparing. ETF flows confirm the institutional shift. After 2 years of consistent outflows, silver ETFs saw positive inflows in late 2025, institutional money returning, pension funds allocating, sovereign wealth funds diversifying. The smart money is moving before the crowd recognizes the pattern. Technical analysis supports the fundamental thesis. Silver broke through every major resistance level in 2025. $50, $60, $70, $80, now testing $90. Each breakthrough accompanied by expanding volume. Broader participation, global buying. Gold to silver ratio tells the story clearly. For decades, it traded around 60 to 80 ounces of silver per ounce of gold. During crises, it contracts sharply. In 1979, it fell below 20. In 2011, it briefly touched 30. Today, it's around 50 and falling. This suggests silver has significant upside relative to gold, not because gold is weak, gold hit new highs this year, but because silver is fundamentally repricing, reflecting its dual role as industrial commodity and monetary metal, reflecting supply constraints that gold doesn't face. Mining fundamentals support continued price appreciation. Silver is primarily produced as a byproduct of copper, lead, and zinc mining. When base metal prices are low, silver production declines regardless of silver prices. Miners can't economically increase silver output by increasing silver mining because most silver does not come from primary silver mines. This creates supply inelasticity. Prices can rise dramatically without triggering proportional production increases. Unlike other commodities, where higher prices incentivize expanded production, silver supply responds slowly and incompletely to price signals. New mine development takes 7 to 10 years from discovery to production. Environmental permitting adds years. Capital requirements have increased exponentially. The pipeline of new silver projects is inadequate to meet projected demand growth. Recycling provides some supply elasticity but operates with significant constraints. Electronic recycling recovers small amounts of silver from devices but requires sophisticated infrastructure and economic incentives. Jewelry recycling responds to price but represents a relatively small portion of total supply. The supply side of the equation is structurally constrained. The demand side is structurally expanding. This creates the foundation for sustained price appreciation independent of monetary factors. Add monetary debasement, and you get parabolic price action. The pattern from the 1970s provides a roadmap. Silver entered that decade around $1.50 per ounce. By 1980, it reached $50. That's a 33x increase. Adjusted for inflation, $50 in 1980 equals approximately $180 today. But the 1970s silver rally wasn't just about inflation. It was about confidence, trust, faith in institutions. When people lose faith in government currencies, they return to metals that have maintained value for millennia. That loss of faith is accelerating globally, not just in America, everywhere. European inflation, Chinese property bubbles, Japanese debt levels, emerging market currency crises. The entire post-Bretton Woods monetary system is straining under the weight of accumulated debt and printed money. Silver benefits from this global monetary instability more than gold because it's more accessible, more affordable, more liquid in smaller denominations. If you have $1,000 to invest, you can buy meaningful silver exposure. Gold requires larger minimum investments for physical possession. This accessibility creates retail participation that gold doesn't enjoy. When middle-class savers start questioning currency stability, they buy silver. When working families seek inflation protection, they buy silver. When small businesses want hard asset reserves, they buy silver. The democratization of precious metals ownership favors silver over gold, and that democratization is accelerating as monetary instability spreads beyond traditional financial markets into everyday life. Grocery prices, energy costs, housing expenses, healthcare premiums, real people experiencing real inflation in real time, not the sanitized statistics reported by government agencies. Actual purchasing power decline that affects daily decisions. This creates grassroots demand for inflation hedges, for assets that hold value while currencies depreciate. Silver is the most accessible option for most people, the entry-level precious metal, the gateway to monetary metals. But institutional interest is expanding beyond retail participation. Pension funds, insurance companies, endowments, sovereign wealth funds, all recognizing that traditional portfolio allocation models don't work in inflationary environments. The classic 60-40 stock bond portfolio failed in 2022 when both assets declined simultaneously. Modern portfolio theory assumes negative correlation between stocks and bonds. That assumption breaks down when inflation resurges and central banks lose credibility. Precious metals provide true portfolio diversification, uncorrelated returns, crisis performance, inflation protection, store of value characteristics that paper assets cannot replicate. Silver offers additional benefits through its industrial utility. Even if monetary demand disappears, industrial consumption provides fundamental support. This downside protection doesn't exist with purely monetary metals. The combination of monetary and industrial demand creates a unique value proposition. Silver is the only asset that benefits from both currency debasement and technological advancement, both economic crisis and economic growth, both deflation and inflation scenarios. This versatility explains why silver outperformed virtually every asset class in 2025. Stocks, bonds, real estate, commodities, cryptocurrencies. Silver delivered superior risk-adjusted returns while providing portfolio insurance. 2026 will test whether this performance can continue. Early indicators suggest acceleration rather than exhaustion. January opened with silver hitting new highs. Chinese export restrictions tightening supply, geopolitical tensions supporting safe haven demand, Fed policy maintaining negative real interest rates. The fundamental drivers remain intact. Supply deficits, industrial demand growth, monetary debasement, institutional allocation, geopolitical uncertainty. None of these factors show signs of reversal. If anything, they're intensifying. China's export controls represent strategic positioning for a post-dollar world. They're accumulating hard assets while restricting supply to potential adversaries. This isn't temporary policy. This is structural repositioning. The United States is responding with its own strategic accumulation, adding silver to critical minerals lists, encouraging domestic production, securing alternative supply chains. This creates competition for limited resources. When major powers compete for the same scarce assets, prices rise dramatically, sustainably, until supply expands or demand destruction occurs. In silver's case, supply expansion takes years, and demand destruction would require either economic collapse or technological substitution. Neither scenario appears likely in the near term. Economic collapse would actually increase monetary demand for precious metals. Technological substitution for silver's industrial applications remains limited due to its unique properties. This creates a supply-demand imbalance that can only resolve through higher prices. The question isn't whether silver prices will rise further. The question is how high they can go before equilibrium returns. Historical precedent suggests significant upside remains. The 1970s rally peaked when silver became obviously overvalued relative to gold and industrial utility. We're nowhere near those extremes today. Conservative targets based on supply-demand fundamentals suggest $120 to $150 silver. Aggressive scenarios incorporating monetary crisis conditions point toward $200 to $300. Extreme outcomes involving currency collapse or supply disruption could drive prices beyond $500. These aren't predictions. They're possibility ranges based on historical precedent and mathematical modeling. Actual outcomes depend on variables that remain uncertain. But the direction is clear. The pattern is established. The fundamentals support sustained appreciation. Silver has become 2026's silent cryptocurrency. Digital money without digital risk, monetary innovation with 5,000 years of acceptance, technological utility with crisis protection. It's the asset that bridges the old monetary system and whatever comes next. And whatever comes next is coming fast. The only question is whether you'll be positioned for it or whether you'll be asking, like millions throughout history, how you missed all the signs when they were right there in front of you. The signs are here. The pattern is clear. The opportunity is immediate. Silver isn't just outperforming other assets. It's repricing to reflect its role in a changing world. A world where currencies lose credibility and hard assets regain respect. A world where governments choose inflation over default and savers choose metals over paper. That world isn't coming. It's here. And silver is leading the way.